You buy your first stock. At first, it feels exciting. You finally have money working for you instead of sitting in a bank account. Then one morning, you check your portfolio. It's down 10%. Nothing has happened to your life. Your salary is still coming, your bills are still the same, but suddenly your brain starts shouting, "Sell before this gets worse." That reaction is stock market anxiety. And here's the truth most beginners don't hear. You may not actually be afraid of losing money. You may be afraid of being wrong. Imagine you invest based on a company's long-term potential. A few weeks later, the stock falls. You check the price again. Then again. You watch financial news. You see someone online bragging about the stock they bought that doubled. Now your investment feels like a mistake. But notice what changed. Was the company fundamentally different? Or did your emotions change because the price moved? This is where investment psychology becomes important. Your brain naturally feels losses more intensely than equivalent gains. A 10% loss can feel much more painful than a 10% gain feels exciting. And uncertainty makes it worse. You don't know whether the stock will fall another 10% tomorrow or recover next month, so your mind starts searching for certainty. You check more information. You look for predictions. You ask other investors what they're doing. And eventually, you may make a decision simply to stop feeling anxious. That is the dangerous part. Selling can sometimes be the right decision, but selling because you desperately want the anxiety to disappear is something completely different. So the next time your portfolio falls, ask yourself one question. Did my investment thesis change, or did my emotions change? If the business, your financial situation, or your original reason for investing has fundamentally changed, reassessment may make sense. But if nothing important has changed except the market price, you may simply be experiencing the uncomfortable reality of investing. Volatility isn't necessarily evidence that you made a mistake. Sometimes it is simply the price of participating in an uncertain market. The goal isn't to become an investor who never feels afraid. That's unrealistic. The goal is to become an investor who can feel fear without automatically allowing fear to make the decision. Because investing isn't just a test of your knowledge. It's a test of how you behave when you don't know what happens next. And that may be the real truth about stock market anxiety.